Welcome to The Landscape, George Smith Partners podcast. Welcome, everyone, to The Landscape. This is George Smith Partners podcast. We're very excited today to have my co-host David Pascale on the line. David, how are you?
Hello, everyone.
Yes, today we have a very special guest. We'll let him introduce himself here in a minute, but we wanted to introduce John Rothfield today, and we'll have a little bit of a discussion on economics. And maybe before we get into it, David, let's let John give a bit of a background.
Sure.
He's been around for a long time and a true expert. So let's why don't you give a little bit of background first here before we get into it today, John?
Okay, well, thanks, Evan and David, and thank you to all the people who are watching. As you can probably tell by my accent, my career started in Australia. So I've done policy plus what they call sell side, but also buy side in my multi-decade career. So I started out at the Australian Treasury doing policy down there. And in America, I've worked for a sequence of banks, mainly Bank of America, as a sell-side analyst on both currency and financial strategy and also economics. And then the last 10 years of my career was as chief economist and portfolio manager at CalPERS, the state pension fund for California, which has, hundreds of $1 billion of assets. And that role included not only managing portfolios such as the US Treasury and an international fixed income portfolio, but also doing things like tactical asset allocation, briefings to the board, things like that. And, trying to show that economics has a role in asset allocation and basically alpha and beta in a portfolio. And I think that was a fairly successful show. And now I work as a consultant for Derivative Logic, which is an interest rate advisory firm that works in a number of spaces, but including commercial real estate. Based on an old relationship I had with one of the co-owners of that firm, Rex Evans. So it's a pleasure, as I say, it's a pleasure to be with you guys today.
We're honored to have you here.
Fantastic.
So thank you for spending some time with us. All right, let's get into it. David, what do we got?
Well, let's get right into it. John, our customers, our borrowers out there always want to know one thing: what's their cost of capital? They're funny that way, and so I'd like to maybe start out with your thoughts on U.S. Treasuries for next year, and everyone's doing their predictions.
Yes, of course, that's an interesting question. One of the most engaging elements of the Treasury market in the year ahead is that we are in a mode now with a Fed funds rate in the high threes, with the market pricing in a Fed funds rate close to 3% by the end of 2026. But we have a Treasury yield, a 10-year Treasury yield, significantly above that at 4 and 4.15%. So really, the question is, if the economy turns out to move in a way that the Fed does indeed do the easing that's priced in, what will happen to the 10-year Treasury? And, it is interesting that the Fed has done all this easing, but there's been a significant steepening of the yield curve. So the difference between the policy rate and the 10-year rate has steepened. The 10-year rate has proved to be sticky. And my feeling is, compared to market expectations, is that I actually think we're going to have a fairly strong economy in 2026. It won't initially be apparent, but as the year goes on, that will probably be the case. And then, depending on what happens to the dollar in particular, I would imagine that the range in the 10-year, which this year was only 95 basis points, if you're looking at a range for the new year, I would say that the range at some point in the second half of the year will test the high side of the yield at 5%. Or potentially beyond. So if you're looking at 100 basis points away from where we are now, I still think that as we progress through the year, the year of the midterm elections, we at some point may see a 5 handle on 10-year bond yield.
Interesting. And I'd like to follow up with that with any comments on Japanese bonds, because they're our biggest buyer of treasuries, and the carry trade is starting to change. And what are your thoughts on that and on foreign demand of treasuries? And that would help with our treasury questions.
Yeah, and that has been a big question all year. The expectation was that there would be a significant exit by central banks, but also private investors offshore into U.S. treasuries, and that would somehow raise the term premium on U.S. bonds. We've actually had a calendar year where, apart from UK gilts, the U.S. Treasury yield has outperformed every other peer market in terms of yield change. The U.S. 10-year yield hasn't been affected by things such as the expected continuation of very large budget deficits in the U.S., the concern that tariffs would cause inflation. So what's going on there? I think number one, there has been a gradual decline, if you look in the tick data and the US balance of payments data, in foreign central bank interest in US treasuries. But locally, there is enough domestic demand, I think, that is made up for that. And so it ultimately comes down to, unless there's a crisis in the dollar, then we are not likely to see a significant sell-off in U.S. treasuries from abroad, creating a significant rise in the term premium. And, as I said, the U.S. treasuries outperformed foreign treasuries all year. But one of the things keeping treasury rates elevated, not rising, but elevated, has been these situations abroad. So we have the new prime minister in Japan, as you mentioned, doing stimulus to the economy. But we also have situations in Germany with increased defense spending. We have Canada and Australia, which are peer countries, looking at potentially raising rates next year because of inflation in those countries. And France and the UK have difficulties of their own. So ironically, it's been some of these factors, not only in Japan, but also in other places abroad, that's led to the elevation of treasury yields. But as to the scenario where suddenly there's a big sell-off in US dollar and a significant acceleration of the sell-off in treasuries coming from foreign participants, I don't expect that to be a huge factor in the pricing of US treasuries in the year ahead.
Okay. And I'd like to go to cryptocurrency. It's a very interesting subject with the Genius Act and in particular stablecoins. Do you see a treasury demand for stablecoins? And this is a two-part question. And I understand that demand is concentrated in the 1 to 3 year range. And do you see possibly the U.S. Treasury reallocating and selling more 1 to 3 year notes and maybe less, and creating some scarcity on the 10-year? And that'll finish my treasury questions.
Yes, and I don't think that's a particularly intrusive management of the treasury portfolio. During the global financial crisis and its aftermath, we had quantitative easing, we had the twist operation. So the treasury has always been reallocating within its portfolio to try and achieve a certain amount of pricing within the curve. And one of the background effects here is that the Treasury Secretary, but also the chief candidates for the Federal Reserve, are looking at making amendments to the Fed Treasury 1951 Act, which changes control of the Treasury portfolio back from the Fed toward the Treasury. There has been the accusation that this massive quantitative easing that's been done has been basically increasing the income disparity in the US through its inflation of asset prices, etc. So the Treasury is trying to get more control of that, and I do think through its the stablecoin issue that they will try and influence the level and the shape of the U.S. yield curve. And again, I don't think that that's something particularly out of the ordinary.
Well, it's certainly true, though, that the stablecoin market is the fastest growing buyer, I believe, of treasuries in terms of
Yes, that's
percentage
right.
basis.
Yeah.
So, if that trend can continue, it could become it could be substantial.
Yeah, it
You know,
could be substantial, and it gets back to the point I made earlier on, which is the marginal buyer of the Treasury traditionally has been the foreign, Chinese, Japanese, Norwegian pension funds, but also individual investors, and that the attractiveness of U.S. bonds because of hedging costs and relative yield has declined. But there are all these other sources of demand for Treasuries that are coming into the market right now.
right. Okay. Interesting. So, tell us a little bit about, where do you see some of the key indicators today? I know that there's been some questions about, the correctness of the numbers coming out of the various reporting agencies, and but there are some trends that I think are worth noting. Like, I believe, for example, that in the last 10 months, it's kind of hard to imagine this, but in the last 10 months, I saw a stat somewhere that the current administration has reduced the federal workforce by 10.7%, from 2.4 million to 2.15 million employees. I think you couple that with, and sorry about the paper flipping here, but couple that with, some of the questions on where inflation's at today. And, we had this inflation print last week, and there's some question as to the accuracy of the data, but it looks like there's some good directionality potentially to the data. So give us some of your thoughts on that part of the market, because obviously, our business is in the real estate finance space, but everything in real estate is at some level a play on interest rates. So just wanted to kind of open that one up to you.
Yeah, and as background, I would say that this has kind of always been the case, but even more so these days, there's been a politicization of economic analysis. You can read the same data in different ways depending on which side of the spectrum you're on. So, um, what I'll try and give you here is my assessment of the way the economy is going, without telling you whether I'm a Democrat or Republican. So, the administration came in January, so it's fair to look at the basically the first 3 quarters of this year. And one of the striking things is, despite all of the changes in policy and the record level of uncertainty, as measured by news flow and chops and changes in policy, the U.S. economy has actually proved to be quite adaptable. Now, it's hard to say what that would have been if it hadn't been for the investment in AI. But ultimately, we're left with the actual numbers, which is in the first 3 quarters of the year, the economy grew by around 2.25%. Domestic demand has grown in the high twos, and one can estimate very differently what potential growth in the economy, but it looks like the economy probably grew above potential. And there was a sequential improvement. So the first quarter of the year was quite weak. The second and third quarters have been strong. You mentioned before pre-Christmas sales. It looks as though November's retail sales were actually quite strong. So the fourth quarter from the consumer has actually started pretty well as well. There will be some elements dampening the fourth quarter because of the government shutdown in the month of October. But I would say overall, we're going to end up with a year that, particularly after April with the Liberation Day tariffs, when folks were looking for a recession, we're going to get pretty solid economic growth. And that's a good platform in which to go into 2026. And I'm mainly talking about consumers and business. There definitely has been a K-shaped element. So lower income earners have their wage growth has declined. And if you look at things like personal income after taxes and inflation, they're still rising, but rising at a much slower rate than they typically have. Therefore, people are really feeling the affordability issue. But somehow, certain segments of the population are continuing to spend, both consumers, high-end consumers, and also segments of the business investment area, such as obviously data centers, but also things like food establishments as well. So I would say that if you're talking about the real economy, things have been okay. If you're talking about jobs, it's definitely been a jobless recovery. So GDP is back to its old trend line, but jobs and hours are still well below the trend line, and we should continue to get downward revision to those jobs numbers. And obviously, you need consumers to have jobs in order to be able to continue to buy. So the question is, if you look at some of the surveys that have come out, particularly from the regional feds, are there some green shoots in the employment area? And we are starting to see a little bit of green shoot in terms of willingness of small businesses plus businesses within the Fed regional districts, the 12 regional districts, to consider increasing their hiring in 2026, assuming that at some point there will be an increased certainty and elaboration of what the end game is on the policy front, which the administration has actually been pretty poor in conceding. So I do potentially see that the jobs market, which once we have the revisions, will show a very weak employment growth. As you mentioned, there's been an 11% decline in non-post office federal workers. It's down to 1.3% of the federal workforce, which is a new low. Whether that's an efficiency gain or something to be concerned about, those workers still have to be absorbed into the market. So there's definitely labor employment is a lagging indicator. And as I say, the question is whether we start to see the lift in the economy starting to improve the outlook for jobs. And I'm a little bit on the fence of that, but also a little bit actually quite glass half full. Now, as it goes to inflation, that's been a particularly politicized issue. If you look at the data, so the 10 months to November, which is the administration, November to January, or January to November, the recorded inflation rate is actually only 2.2% versus 3.0% the year before. And if you take out things like food and gas, and even if you take out shelter, there has been a decline in inflation. Now, the November the November CPI report was particularly egregious. Some of the assumptions they made were all in favor of showing lower inflation, and that number will continue to be held into the underestimation for a whole year, because they're not going to go back and change that estimation. They're going to continue to go on a month-to-month basis from here. So economists will continue to argue, certain economists will continue to argue that inflation is probably about 0.3 higher than has been recorded, and that distortion will continue for a whole 12 months. But ultimately, even if you add that 0.3 back in, it is true that inflation, given what we expected to happen after the tariffs, has been remarkably subdued. So again, if you look at everything, sorry, go ahead.
No, I was going to say just to that point though. At the beginning, your first point you made is that you think we're going to be living in a 4+ 10-year environment.
Mm-hmm.
So if you have that, you said maybe even end up next year over 5% for the 10-year. So if we're living in that world, don't we kind of need inflation to really be around 3% to sort of get to sort of I'm more concerned about disinflation and deflation personally, because I think we're living at the cusp of like the most deflationary force of all time, which is this AI boom that we're having. And yes, we're having some interesting sort of short-term aberrations in terms of labor, as we're putting up these facilities, and maybe some obviously chips and certain things that are in high demand are in, but let's just talk through, what about like the implications of this? Like, what do we actually need to see? I think, you've actually made mention that this sort of 2% inflation target is sort of a man-made number, and that it was, I think New Zealand that decided they needed that, and now everyone thinks they need that. So, where do we need to be?
Yeah, and look, we are going to see the next two inflation numbers are actually going to be very low, because a 0.5 and a 0.4 drop out from a year earlier. So we are going to continue for the next couple of months to get fairly low prints on headline inflation. The question is, There's a measure of what we call underlying inflation, which is inflation taking out the noise. Now, economists typically take out all the important things as noise, but it is a legitimate concept because they try and take out elements that are volatile. So sometimes they're strong, sometimes they're weak. There's a high frequency change in the inflation coming from things like food and energy. And that's why we take out, that makes it core. And then you can take out further things, which means basically underlying inflation. Those underlying inflation measures are still at around 3%. So you can say that if the economy picks up, if foreign interest rates continue to remain elevated, and then some of the noisy stuff in inflation begins to pick up again next year when you start to get an improvement in the labor market. That's the kind of scenario that could take you back toward 5% on the 10-year Treasury. I'm not prepared to say that's going to happen in the first quarter at all. As I say, I think the next couple of inflation prints are going to be may surprise some people on the low side, and there will continue to be talk about kind of artificial distortion to those numbers. And maybe I think the labor market has been weak enough for one of the last 3 Chairman Powell meetings to include a rate cut. Whether it be January, March, or May, I think are his 3 remaining meetings January, February, and April, I think it is. I do think there may be one further cut in those meetings, particularly after we get these revisions to payrolls for 2024 and 2025, and we get these next 2 inflation prints. So I still think the direction of travel potentially in the next couple of months is low rates. But as I say, as the year progresses, we get potentially further stimulus from the administration into the midterms to try and limit damage that's going to be done to the Republican majority at that time. Then we do see kind of a resumption of strength in the labour market and potentially a little bit more permanent employment. They're the kind of scenarios that would take you back to 5% in the 10-year bond yield.
Interesting.
Right.
That's very interesting. Go ahead, David. Sorry.
So watching employment is maybe the new driver of the dual mandate. Do you agree? I think that that is something the Fed, the committee members are starting to watch more. And I think that goes back to your K-shaped recovery also.
Yes, that's right. And, one of the elements of employment is a lot of the regional feds have done this work on what's the new normal for monthly employment. We used to think 100 to 150,000. In a boom, in the early part of an economic recovery, it's 200,000 to 250,000 a month. But with issues around the population and the administration's efforts to try and make most of the growth in the labor force and employment over the next 3 years coming from native-borns rather than foreign-borns, the new normal is probably more like 50 to 75,000 per month. And so the Fed should be setting policy to that degree. But right now, if you look at labor demand versus labor supply, which is the categories that Jay Powell talks about, labor supply is growing faster than labor demand. And you also have an increase in people doing part-time work that don't want that. They want to be working longer. The so-called marginally attached who are in the workforce. Recently, we had African Americans and Hispanics increasing their participation in the labor force, and they need to be absorbed into actual jobs. So I think regardless of who's the next Fed chair, I think that has become, again, the most important part of the dual mandate, as you say, which would continue to have an easing bias at the Fed, whether it's they move back to more irregular cuts versus the regular cuts that they've been doing in the fourth quarter.
Interesting.
Any comments on going to the extreme here, yield curve control or anything like that, Japanese style yield curve control coming? We've heard about Treasury buybacks of bonds and this new, like, it's not really QE, but some bond buying to kind of rebalance the repo market. Any comments on those technical aspects?
Yeah, I think the Fed and the Treasury will continue to do various operations. In the last Fed decision, a decision was made to the Fed has stopped its quantitative tightening in the interests of so-called ample reserves, and it has decided for a period here to be increasing the purchase of Treasury bills again to increase the concept that we are an ample reserve system. We don't have to worry about a collapse in the functioning of the markets, so we have to worry about it, but to a lesser degree if we continue to have so-called ample reserves in the system. And yes, I think yield curve control, which is something that the Japanese have been doing, and quantitative easing. Yield curve control, I don't think that they'll ever announce targets for the 10-year bond yield, but they will continue to do operations like twist and manage the supply in different segments of the Treasury market in order to achieve some of their objectives. They don't like the yield curve being too steep, so ultimately, they will try to manage that. And it is interesting to me this whole issue of very interesting to me this whole issue of the Treasury Secretary and the key candidates for the Federal Reserve wanting to wrest control back in the management of the portfolio. And it goes to this issue about the difference between freshwater and saltwater economics. Freshwater economics is this kind of the center of America, around the Great Lakes and the freshwater rivers, etc. And that tends to be more conservative economic policy making. It says basically you can have business cycles and less interference because economic agents go about changing their own behavior, and ultimately you come out of a downturn. The saltwater folks are more inclined to look at intervention, which includes things like quantitative easing. Evan and I both happened to go to UCLA. I was in economics.
Go Bruins.
He was in business school. And interestingly about UCLA economics, it was a hybrid of fresh and salt water. And so we had we had a lot of monetarists there, but we also had some of the folks who were doing a lot of the more left-wing economics for some of the countries in Latin America. So that is an interesting issue to me, is that this whole issue that the Treasury and the key people that may be taking over the Fed are very critical of past efforts of quantitative easing. We all lived through the global financial crisis. We lived through the pandemic, where there's an issue of a shock and awe in policy. Risk management said you had to throw everything at these problems to avoid having the Lehman's crisis, et cetera, again. But I think going forward, we aren't going to have those same concerns about moving back to the zero lower bound on rates. And therefore, I think that, again, this whole idea that the Fed's policy has been kind of orientated a little too much to policies that have inflated asset prices and increased income disparity in the US, they will go away. But of course, that contains some dangers as well, in that people feel less confident if there is some kind of crisis that the Fed is going to be coming in there and be the supporter of last resort.
Interesting.
Thank you.
So why don't we talk a little bit about trade policy and where that sits today, if you don't mind.
Sure.
And I think everybody's thinking about AI and what it means to be, have AI supremacy. Do we need that? What does that mean? I think right now, our trade policies are also kind of at odds, and sometimes not with our AI policies. I think that, let me give you some examples of this. We have an incredibly competitive, probably the most competitive market right now amongst these 4 or 5 major AI companies in the US. A lot of competition is very good for progress. At the same time, there's some concerns about what it means over the long term, with respect to what will AI do to the job market. I think the short term, over the last 3 years since the release of ChatGPT, occupations with high exposure to AI have actually seen 1.7% job growth. versus 0.8% for others, and 3.8% wage growth. And there's been no major disruptions yet, right? There's been productivity gains so far, but the jury's out, right? I mean, we'll see what's going to happen there. And I guess the question is that I have, over the last few weeks, we've heard reports out of China that China has basically, developed their own EUV lithography machines, et cetera. And they're going to be, obviously able to compete much more directly on power than we are. They have this centralized support for AI and for power. So if their chips are a little bit less efficient, they can put on more AI more quickly and potentially outcompete us. So a little bit of an odd question here, but I'm just thinking about our trade relations, what the Trump administration will wake up and do tomorrow on whether or not China will get different chips, what that means to the American worker. It's sort of a very difficult question because there's no real question in there. It's more of obviously we want, very full employment here in the US for the American worker, but at the same time, AI may be a double-edged sword. The second edge of it is sort of yet to show up, but it could show up. So just kind of curious what your thoughts are there.
Yeah, well, first as it regards to trade policy in general, I think the administration caused a lot of bad will early on in the year in April when it did its Liberation Day, because its estimation of the tariff rate for different countries was completely at odds with any form of rationale that could be defended in economics. So you start out immediately with bad will. And let me say that tariffs have been successful. They've reduced the trade deficit and they've reduced the budget deficit quite noticeably. Since the administration's come in, the budget deficit's down by about $400 billion on an annual basis, and the trade deficit's down by a similar amount, and half of that reduction in the trade deficit per month has been due to tariff revenue. But it's so they have kind of got away with the system, and it depends what the Supreme Court does as to whether they have to come up with substitutes for this in terms of how they replicate the tariff revenue they're getting now through other means if the Supreme Court turns it down. So ultimately, there has been enough adaptability, and profit share of GDP was high enough that businesses have been able to absorb a significant amount of the tariffs. And also, the tariff goods are a relatively small portion of the CPI, so there's been a lot of offset. So I would say that the tariff policy has led to a decline in the twin deficits, which are one of the key underpinnings for the US bond yield, the term premium part of the US bond yield. So to that degree has been somewhat successful, but it has been very disingenuously arrived at, arbitrary and subject to changes at the whim of one person rather than going through a typical analytical process. Then there has been this politicization of the tariffs, which is deal making associated with the introduction of the tariffs, and that's where the issues around China, et cetera, come. So the way I think about the AI issue, and I know I got pushback about this when I talked about the Australian mining boom and all these other booms, tech booms in the early 2000s, and also some of the railway booms that were happening back in the 1800s in Britain, and AI, if you think about it in those terms, though, there are still two elements to AI. One is that a rising tide floats all boats. So the wealth effect, all of these Mag 7 and these hyperscalers are all domiciled in the US. But there have been significant foreign buyers of these stocks. So there's kind of a lot of the wealth created has been in the US, but a lot of the wealth created has been abroad. But the way to get access to this stuff is through investing in the US. But the rising tide floats all boats says basically the impact of the investment. And then the wealth that's created, both domestically and abroad, has created increased spending in other areas of the economy. The rising tide floats all boats. So there's an income effect from the development of AI. But there's also a substitution effect, which is saying that there's crowding out has occurred. So if you look at 8 months worth of, 10 months of the administration electricity prices, I just did again the numbers. Electricity prices have risen 8%. Things like natural gas utility prices have actually been much more muted, but there has been an increase in that. And of course, these folks have been borrowers in the debt markets as well, and that has kind of crowded out, along with government borrowing from other segments of the economy, and probably helped to keep rates elevated. When people looked at the Australian mining boom that happened in the early 2000s right through to the 2010s, the counterfactual said that inflation is higher and central bank policy rates are higher than if we hadn't had this boom. And so there's something called the Dutch disease that says it's good to have a discovery like this, and particularly with these firms largely domiciled in the US. But there are also some problems, particularly related to the crowding out of other sectors. And as you say, these sectors aren't very labor intensive. So that is the problem. And the question is, look, I'm not an expert on AI in any form. I have no idea of the relative competitive advantage that the Chinese enjoy versus the Americans. But I will say this is that with past booms, there's been kind of a clearly defined output as to what things are going to look like at the end. And I don't think we have that with AI. What's the impact going to be on employment? What's the impact going to be on GDP? Whether they're going to be jobs created in other industries that lead to a net gain in employment, because AI has freed up people from certain tasks into doing other tasks. It's a very unclear situation at the moment, particularly since the leaders of this industry haven't really given voice to what the end game looks like, and a lot of the investment seems to be FOMO, fear of missing out. And we don't know whether that's going to end. There are going to be some companies fall by the wayside, and
That's right.
very few companies are going to end up at the
I think
top end.
I think what's really interesting about this, John, I think you kind of hit the nail right on the head, which is that it's difficult to understand what the exact impacts of AI are or might be. But if you look at companies who have invested significantly in automation and are now kind of reaping the benefits of that automation, even companies like Walmart, who have just absolutely crushed it relative to their comp set, like Target, who sort of failed to make the changes they needed to make 4 or 5 years ago. Walmart has aggressively invested in AI automation and robotics, and it's kind of showed up in their numbers, right? They've continued to have strong productivity gains, cost reductions, which, we do have this problem that you just mentioned with the wealth effect and this K-shaped sort of effect that AI has on the economy. But maybe, the overall benefit, which is that the company can operate at a better margin and still, sell their products at a lower price. Maybe that does benefit the bottom third of the economy. I'm not sure. I don't know if people need more cheap stuff. But it is very interesting. And then, you mentioned power. Power is super important. But what's really interesting, what thing that I've observed, is that these AI models are getting more efficient at a rate of like 300 to 400 times per year. So perhaps we're in a bit of a power bubble here. Only time will tell. And of course, now everyone's talk is data centers in space. You don't have to deal with the local homeowners association if you just put it out there. And if that's a big enough deal to pull Jeff Bezos out of retirement, I don't know. It's must be very real. So no, it's a very interesting thing because it's not only something that affects us domestically, but it affects the globe. And also, you want to win in this area, because if we're not going to win, whoever wins will dominate. So
And that's a more
It's a tough
geopolitical
balance.
fear of falling
Yeah,
behind your competitor, right? But I think one of the key words you used there was relative. So Walmart is doing well relative uh, to Target.
Target or its comp set. Yeah,
So,
yeah,
but you can't say that between them, Walmart and Target are doing better as a result of AI. One has been an early adopter and done well, and it has cannibalized from the sales of Target. But
interesting.
but in a market where you have very limited employment growth, so far it's a substitution effect rather than income effect, and so.
Interesting.
Yeah, and it
Yeah.
would be interesting to look at that in more detail. What basically the Federal Reserve does a bi-monthly survey. I think that bi-monthly means twice a month of people's adoption of AI. And, basically 1/6 of firms are using AI, and it's expected to go to, 1/5 by the end of by 6 months from now. But there's very little about how folks in general are using AI and whether it's increasing productivity, whether it's
Productivity.
labor replacing, etc. So there's so many questions about this, and we were brought up in neoclassical or Keynesian economics, and this is a new thing that we're grappling with. But one thing we always have seen, this is a replay also of so-called supply side economics, right? So it sounds like you're supporting the supply side issue, which is that this thing is going to be disinflationary because it's going to the spending is going to increase supply more than it will demand, because it's creating more productivity than it is employment in the short term. And that may be the case because it's different to the supply side arguments that were being used by the Reagan administration and the so-called Laffer curve, which is basically you jet charge the economy and it creates more revenue than spending. So the supply side issue, I think, is a key issue for the economy. And it really is interesting. I do think that in the last couple of years, once you get these revisions to employment, you are going to have quite a lot of GDP growth, but you aren't going to have a lot of jobs growth or even growth in hours. So there is a productivity increase going on in the economy. And how much of that is occurring is only going to be clear when the fog lifts from the government shutdown and various revisions to the labour force, which are going to happen in January and February, the benchmark revisions, which take out all of that employment growth that we had in 2019. And then we're going to be able to have a greater assessment on whether this is more of a supply side than a demand side phenomenon at the moment.
Interesting. Very interesting. Okay, good. David, any final questions here for John as we kind of start to wrap it up here?
I do not have. I think I got all my questions answered. And it really was an amazing responses. Thank you so much.
I appreciate it.
Yeah, John. So where do people find out more about you and derivative logic?
Well, I'm a consultant for Derivative Logic. So on Derivative Logic's website, which is a very thorough website, there are two macro products that come out. One is by Jim Griffin, who produces a weekly, what they call Straight to Smart publication, which tends to be more written. So, and that's very well. That's very well has a very large client list, and also very high readership. According to our internal data. And so that comes out once a week, but then also once a month on the Wednesday after the employment report, which has been a little bit iffy recently, I do something called What I Learned This Month, which essentially is a 20 to 30-minute wrap on things that have changed in the last 4 weeks of data and politics, and therefore how it may affect the future. Because we do have to spend a lot of time thinking about what's just happened and what's happened in the past, because it's the indicator of what's happening in the future. When you're handicapping a horse race, you don't pretend that the horse has never run before. And so it's important. And once a month we had an investment.
So 20 things I've learned this month. Is that right? Man, I can't 20 things in a year. I'd be happy. So
Well,
I should definitely.
Yeah, it's just what I learned this month. So
I'm just.
oh
That's
yeah, yeah.
great.
There you
So
go.
where do people find that, John?
Well, through Rex, Rex and Jim, the co-founders of the company, can certainly have ways that you can log in. You can log in
We'll put it up
and
on the screen for folks.
you,
All right, we'll find that
Yeah.
afterwards, and we'll put it up. We'll put it in the
yeah.
notes below
Rex,
for
Rex can do that,
listeners.
and
Make sure
then
that people.
basically,
Perfect.
yeah. So people can do it live, but it's also something that can be watched after, and it's one view out there amongst many, but but I think it has been a fairly useful addition to what Derivative
No, it
Logic
sounds
does.
great. Yeah. All right, John, this is very good. So for our listeners, of course, go to gspartners.com, sign up for FinFacts there. You can also read more about George Smith Partners. Very glad to have you on today, John. You certainly have a grasp on this stuff that very few people have. So it's very impressive, and hope to have you on sometime again. Maybe we'll do this in another 6 or 8 months and see how things
See how
are
the
moving along.
predictions come through.
Yeah.
Perfect.
That sounds great, and it's been an absolute pleasure, and we really enjoyed being in your office.
That was
A
great.
couple of weeks ago. It was very erudite and very engaging. It almost took me aback, the quality of the two-way conversation that was going on. So you're a good firm, and you're a very good firm in your space, because you realize that all these markets are interconnected, and ultimately the pricing of in your market is due to factors that are so extraneous in many cases to your
That's true.
raw business. So
That's right.
and obviously you guys are very much in that mode. So I appreciate it.
Thank you,
All
John.
right.
All right.
Cheers.
Thank you.
Cheers.
Thanks, everyone. Cheers.